G'day, I'm Scotty North, and this is Xenium.Live, where we talk all things money, finance, and property. And it is a Thursday lunchtime, so grab your sanger and your breaker and sit down and have a listen to what we got on the show today, because today I have PJ Patterson from Keystone Financial. PJ, how you going, mate?
I'm doing really well, Scott. I'm just sussing out where I might go on holidays here. I've already decided to hang up the stocking so Santa knows where to bring my stocking stuffers for the year. But other than
Right.
that, the countdown is on until Christmas. I'm excited for the end of this year, as I'm sure many people are. And I'm also excited to be able to take a break here in another couple of weeks for hopefully a couple of weeks myself.
Yeah, well, I mean, it's that time of year, and it's the crazy time, and everything's speeding up towards the end, and just when's it gonna stop? And it stops and just stops dead, right? So, but what we're talking about on today's show is, well, it's just that it's the crazy season. Now we've had the U.S. election, and we've had these markets doing some weird stuff. So, mate, tell us what's going on in market land and what we can expect to look out for coming into this time.
Sure, no problem. Well, we had a GDP figure come out yesterday, and the good news is Australia is out of recession. We had a GDP print for the quarter of up 3.3%, so that's a pretty good quarter. We're still down for the year, obviously. I think that we're still negative 3.8% year over year, but we are now definitely out of the recession period, and I think we're going to be continuing to power ahead over the next couple of quarters. We've talked about that before, and I'll elaborate on that a little bit today. But certainly that was a good positive thing to have occurred yesterday. Along with that, there were a whole bunch of other metrics and data points that got released. I don't know if you saw the article that I sent you. You might have that handy, but if not, I can just rattle off a few of the things that I think are very positive for us. First and foremost, as I said, we had the GDP number, which was up 3.3% on the quarter. Interestingly, dwelling investment is also up, having been negative for a number of months. Dwelling investment rose 0.6%. Now, that doesn't seem like a big number, but when it's been negative for so many months, to have it be positive is probably an interesting sign, of course, that we're seeing renewed economic activity in the construction sector and in the housing sector and so forth. So that's a real positive.
So dwelling. Just to clarify, dwelling is got to be something where someone lives in. So
Well,
it's not all construction.
Yeah, housing, basically housing. Yeah, and it was actually 8 consecutive quarterly falls in dwelling investment. So to have a positive quarter, having had 8 negative quarters, or 8 not negative, but sorry, falling quarters, is probably a sign of again, a lot of the activity that you would have expected to have occurred because of all the stimulus that the government and the Federal Reserve, or the Reserve Bank here, has put into the economy. So we already know that there's been broad support for housing. The government has, put all these programs in place. We've had, of course, the renewed discussion around canning stamp duty, which could be an interesting thing for next year. But the fact that the housing sector is rebounding in terms of dwelling investment is a very good sign, because it contributes a lot to our GDP. So that's a really good thing. One probably slightly negative was the fact that I'm just trying to find the actual figure here. In business investment, or investment by businesses, had fallen, and I think it was a minus 0.3%, which isn't a great number, but it probably just shows you that businesses are still a little bit cautious about reopening. So, and we've talked about this over the last couple of segments where we've talked economic stuff. We have seen the economy rebounding nicely. A lot of the segments and sectors in the economy beginning to show signs of life again, like your hospitality, your retail, all of these things. And I think I said it at our last market update that the RBA and the Australian government has really set the table for us to have a strong end of year, and that's very much evidenced by the fact that household spending rose 7.9%. So that is a pretty big number, and what it means is that people are out there spending more money, and that's a lot of discretionary type spending. So again, that's going to be adding to our GDP. But it just goes to show you again that we went through that whole sort of shutdown and really bad economic period, and there's a lot of pent-up demand. And I don't think this is going to be a one-off or a one-hit wonder in terms of this quarter. I think we're going to see that continue, or it's probably continuing as we speak, because we're in November or December now, and so we're in the December quarter. Look, we should have another great print when we get the GDP figures for the December quarter, sometime Jan-Feb. So all things.
So I've just. Yeah, it's very positive. So this is the article you're referring to here. So Australia's no longer in recession, and he mentioned something before that the housing numbers are up, and that forms a big part of GDP. Now, without getting too much sidetracked here, I mean, does that actually do good for GDP? Like, I mean,
yeah,
that. Are we talking about, is that the construction component of that, or it's actually activity, or is it the house price values, which actually does nothing?
No, these wouldn't be house price values, so that's not the metric. A dwelling investment, I would say there's probably, I don't know what is broken down in that specific figure, but there would probably be, I don't think I had this metric in this article, but there would be, a construction, I'd say there'd be some sort of construction figure, building approvals, that sort of thing. I suspect that those are up. I'm just scanning quickly to see if I can find that number. I don't see that number, but in any case, you would expect that if housing or dwelling investment is up, then you would expect to see, and maybe not this quarter, but certainly, or the September quarter, maybe in the December quarter, we would probably be seeing construction approvals and building approvals rising, and generally speaking, money coming back into the construction sector. So the fact that dwelling investment is up, having been negative, or I shouldn't say negative, having had previously in the previous 8 quarters, so 2 years, for the previous year, that had been falling. So to see that now change, to see that pivot and it rising, now obviously we'll want to see some follow through when we get the December quarter numbers, but if that continues to be positive and growing, that's a really good sign that we're absolutely out of the woods from this COVID funk that we have been in over the last year.
Now, I'll just get you to explain how the figures, work, because if we had a big decline coming into, and during Corona and all the related things that went on there, then we had that sort of, almost fall or stop and fall off a cliff type moment. Are the figures, what figures can we look at where they say, okay, we were here and we're back to there and past there again, in terms of because it's very easy to say when you start from a low base to say, oh, we're back into growth, but yet we've still got to claw back all this other ground before we even get to where we were. How do you look at figures like that?
Well, of course, and one of the ways that you do look at those figures is there's this thing called the base effect, and not to get too boffiny about this sort of thing, but when you have a really bad quarter or a really bad couple of quarters, the comparative period, so a year later, when we look at the June quarter, so next year's June quarter, is going to be awesome because we had a horrendous June quarter this year. So the base effect is that, I don't know, GDP was down, whatever it was, 6-7% or something in the June quarter. In the June quarter of 2021, it's probably going to be up 4 or 5%. So there's going to be this massive uplift in GDP. Now that's going to get a lot of airplay. That's going to be really positive for stock markets, particularly in Australia. So when you're talking about how you compare things, that's what you do, is you start with a base effect, and then you see what, first of all, the direction of the metric is. So we want to have seen, and we have seen this now, we want to continue to see the rate of change to be positive, in the positive direction. So going back to GDP, we had negative GDP prints for a couple of quarters. It was slowing into the beginning of this year anyway, and now we've turned the corner. Now we've seen the rate of change begin to be positive, and the rate of change is going to accelerate to the upside. So that's a very good thing for investors overall, for the economy and all of that. But yes, there is ground that needs to be made up. There's no doubt about it. And so, you could look at any number of metrics. Probably the best thing to do would be to look at a chart of something and say, well, where are we at right now in terms of the overall number versus, say, a year ago in terms of activity levels? So I was just trying to think if there's a place we could quickly go. Probably not to get a chart on this, but as an example, building approvals, that number, or not building approvals, dwelling investment, it had 8 consecutive quarterly falls. So a 0.6% increase isn't going to get you back to where it was 2 years ago, right? It's going to take some time for us to work back to that level, I guess is really what you're asking me about, yes?
Yeah, that's right, mate. Yeah, so I mean, I'm pretty, I guess, bullish on the future. I'm quite buoyant about what's going on, and us as people have survived this corona event a lot better than what perhaps the numbers originally suggested we might. But it's very easy to say, well, it was so bad. It's like saying, you're at a 10, you go down to a 1, and then you get to 2 again. You go, oh, we've doubled, but you're still nowhere near 10, right? So, like, I mean, it's just kind of going how the figures work on that. And the other thing I wanted to talk to you about, which might actually come into this, is in the article you put on the screen here that our buddy Philip Lowe, Reserve Bank governor, is talking about the unemployment rate, and he spoke about that last month in his last 2 months actually in his reports. They're watching that quite closely. The unemployment rate sitting between 7 and 8%, which I guess is. Do you know what their target rate is? Is it 5 or 6 or 4? I can't remember what it actually was.
I think the target unemployment rate, I dare say, would probably be around 5% or less. I think that's kind of full employment for the Australian economy, somewhere around that level. So probably 4 to 5% would be their target. And certainly that is a metric that they're very keen on, reducing, because the more people that are out of work, that's a bad thing for the economy, right? So you want to make sure that you're seeing that unemployment rate dropping. By the same token, the type of jobs people are getting, you also want to see that they're not. So the way they count statistics on this, or if you have, I think if you work 1 hour a week, you're considered to be employed. So we certainly want to see the jobs that are coming back into the market be the jobs that were, destroyed, or people that were laid off from their jobs, that they get their actual original job back, and then we're not just creating, part-time jobs or other sort of less contributory jobs than what we had pre-COVID, if that makes sense. So we want to just, as we see the unemployment rate drop, we want to make sure that people are going back to the things they did before the whole COVID crisis hit us. But it is a very
yeah, that's right. And what he's gone on to, they quoted him saying here that they're interested in the unemployment rather than excess borrowing. And when you're reading between the lines, it's because they're saying that the people who are unemployed don't borrow, and they also then have trouble servicing their debts.
Sure.
So they're not concerned about taking on excess debt. I guess depends the way you look at it, right? Because if they have debts they can't service, then they've got excess debt already, not necessarily taking on new ones. So to me, it sounds a bit like they're just talking around issues and probably don't, have a whole heap to say on it other than just watch this space.
Well, I think so. And, just to that point about the excess borrowing versus employment, as you mentioned, excess borrowing right now isn't a big deal for the economy because, and I think he probably made that comment because they were targeting the investment borrowing market about 2 years ago. And they were trying to, I suppose, take some of the heat out of the Australian investment market, investment property market in particular, because it had gotten ahead of itself. And they were just wanting to make sure that it didn't really go too far into bubble territory. So what they're really saying now is, well, we've had an economic crisis. A lot of people have lost their jobs. A lot of demand has come out of the market naturally because, of course, there's uncertainty, concern, especially in the investment market. And if anything, there's probably been a pivot to more people buying homes to live in, owner-occupiers and the such like. So I dare say that the investment market still has a long way to go to sort of fully recover. And that will recover off the back of people getting their jobs back, confidence returning, those sorts of things. So again, I think that's why they're not particularly worried about excess borrowing, because they also know that when people borrow money, they're typically going to go out and spend it on something, hopefully a home renovation, or they'll be buying a car, or something like that. They will end up, we hope anyway, putting that money to work in the economy, and then we'll get a multiplier effect in the GDP where every dollar spent, every dollar borrowed money spent gets us, $2, $3, $4 sort of economic output. So that's probably, again, why they're not too worried about excess borrowing.
Yeah, okay, no, that's a good point. So back onto one of the topics of the day was the stock market, which you could have covered, but what to look for in the Christmas season. Now, I don't know, I'm not a stock guy, right? So there is some saying about the US stock market in September or something where it goes away and comes back again in November or whatever. I don't know if we saw that. There was all the election this year.
You're close. The saying is sell in May and go away. So it's the summer season up there, May to sort of September. That's the old saying. But look, most of the trading that's done these days on the markets is computers anyway. So gone are the days of the stockbroker going on summer vacay and the markets volume and other metrics sort of slowing down because machines drive most of the frequency, high frequency trading and things like that.
High frequency trade. Yep.
So sell in May is probably a very old adage, but interestingly, the U.S. stock market, just to pivot to the stock markets around the world and globally what's going on, the U.S. stock market has been hitting new all-time highs, as has the NASDAQ, which is a good sign for those markets. The Australian market is still about 5.5% below its peak. So I'm just looking at the metrics now. The Aussie market last year peaked at 72. This is the, I think this is the all-or. It's peaked at 72.55. That was the index number. And we're currently trading at 68.55. So we've still got about another 5.5, let's call it, percent before we get to back to our all-time high. Now, I suspect that will happen sometime in the first quarter of next year because, and I use this thing called the quads, looking at the full cycle investing and macro investing around the world, and we put every country into a quad. Well, Australia is right now in quad 2, and it's going to be, in quad 1. It's going to be in quad 2 for the next 2 quarters. So the first quarter and second quarter of next year, so the Jan and March quarter, or the March and June quarter, if you will be quad 2. Now, this is a great quad to be in. It means economic activity is going to be firing. It means that we're going to see a little bit of inflation in the markets, but you can pretty much at that point, not exactly, but you can almost throw a dart at the stock market and probably will make some money in stocks. Now, there's a few sectors you'd want to stay away from, fixed income in particular, because that's not a place that you want to be in quad 2 when you're reflating. But certainly, and I think we've talked about this before, but certainly things that are good inflation hedges, broadly equities, credit, commodities, consumer discretionary, technology, industrials, and energy are also top asset classes that you would want to be allocating capital to at this stage. You'd probably want to be selling things like gold, fixed income. You'd want to be away from really sort of high dividend yield stocks, things like that, probably underweight those, and just flat out not in any sort of Australian sovereign bond or any of that sort of credit type exposure. You'd want to be out of that completely.
Right. And maybe Australian wine.
Well, you know what? Wine is always a good investment. It's sort of like classic cars. Wine does seem to have a very low beta, which is good, and it tends to preserve its value. Now, it does preserve its value, but the problem with wine is it doesn't necessarily get preserved because, of course, we like to drink it. So if you're going to make wine an investment, I suppose you'd want to have some to drink and some to potentially sell down the track.
No, fair enough. So coming into this, the Christmas time, I mean, if people they're looking to go away and do other bits and pieces, is there something that they should do to their portfolio of investments to prepare for this time? Do they just leave it and say, okay, we'll just whatever happens, happens? Or do they put some certain things in place? I mean, it's a very broad question because you don't know what they're invested in. But is there a generic event we should be looking for? Is it just like, no, it's business as usual? What happens at this time?
Yeah, very good question. I think if you have your portfolio set up to be a quad 2 portfolio, and if it's set up for that right now, then there is nothing you need to do. You just sit on your hands and do nothing. If you did have some cash sitting on the sidelines still, and you probably should, even in a quad 2 portfolio, you don't necessarily have to be fully invested. You could be 60, 70, 80% invested. And if you had some cash on the sidelines, any sort of short-term sell-offs in the market, and we always get those, right? Because markets don't go up in a straight line. There are zigs and zags along the way. It's an opportunity to add to positions that you might have on. But all the things I mentioned earlier would be key asset sectors or sector exposures that you'd want to have on. And you know what? You could probably leave those on until probably June of next year at a minimum.
Okay. All right. That's good. So it's looking to be a better Christmas than perhaps what we thought in June.
Oh, for sure. Well, I think in June it was probably the darkest hour, and it was certainly very dark back then. A lot of doom and gloom out there. We just didn't really know how the COVID thing was going to continue to unfold, and and there are still problem areas around the world, in particular the U.S. And a little bit in Europe. But look, broadly speaking, unless there's something that comes out of left field, and let's face it, no one, and I mean no one, will know what that is. It will just happen, and it could disrupt markets. That's called a black swan event, and these things can and do happen. But at this stage, we are well on our way on the globe, in the entire world. In fact, the globe is going to be in quad two in the first 2 quarters of next year. This is pretty unprecedented. Every country in the world, practically, that's an advanced and sort of developed economy, and emerging market as well, is going to be in quad two. And this is going to be just a fantastic situation for investors for the next 6 months. No doubt about it.
All right. Well, that is very good news, and it's a great thought to go into Christmas on in terms of financial markets and the outlook for next year. One thing I wanted to talk about, and well, actually 2 things, is that we touched on in our last shows, the pricing in of markets for the US election, especially the US stock markets, and had they priced in a winner, had they, so my first point of the question is, to me, it seems pretty certain that the winner has been announced, even if perhaps Trump doesn't think that may or may not be the case. But are the markets acting like the winner is set in stone? That's the first part of my question. The second part is, in the past, say, 7 days, there's been a lot of talk about the corona vaccine, and I believe that the UK is going to roll one out next week, potentially. I think they're looking at slower timeframes here. Has the markets responded to that news, positively or negatively? Just those 2 points.
Sure. So just on the U.S. election, I think it's pretty clear that Joe Biden is the president-elect. I know that Donald Trump is continuing to agitate with some lawsuits and things like that. I really can't see this going to overturn the election result. I think it's just Donald Trump being Donald Trump and being a bit of a sore loser. But the market's definitely priced in now a Joe Biden victory now, or presidency, I should say, and he's begun to make cabinet announcements and key positional announcements. Now, interestingly, on this subject, Janet Yellen, who you may remember as a Fed chairwoman prior to the current chairperson, who's Jerome Powell, has been basically, she's going to be the next head of the Treasury. Now, she is a absolute dove, and what that means is...
Oh, that's really nice, mate. You're talking about it very, very prettily.
Well, it's probably for a guy like me who likes the idea of sound money and that sort of thing. I really don't want her to run the printing press 24/7, but that's what's going to happen. So one of the things that's going to be probably coming down the pike in the new year in the U.S. in particular is, and they've sort of have to do this because they've got so many people unemployed. They need to do something to stimulate the economy. Now, the problem that we've had in the last year to 18 months is that a lot of the money that was printed and any of these programs that were put in place by the Trump administration, they went to the wealthy. They went to Wall Street, and they benefited the big investment banks and investment houses because, of course, what they want to do is they want to take a lot of risk in the good times. And then when the poo hits the fan and they start to lose money, they run cap in hand to the Federal Reserve and to the Treasury to bail them out. So they want to play capitalism when they're winning and socialism when they're losing. So this is the problem right now with probably Western democracies and capitalism, is that sort of thing happening. But anyway, back to Janet Yellen and the Biden administration. It's quite clear that they are also modern monetary theory people. And what that means is you hear these things about, a minimum wage for everyone and basic health care and basic, services from the government. Well, they're very much in that vein. So we could very well see a lot of programs being rolled out in the U.S. next year where people are given free cash. And so what effect this will have on the economy, who knows? It probably will give a bit of a boost initially, but the burden of that, down the track will be something that we just won't know the result of. So that's the whole Biden issue. And then the second question was on, just refresh my memory, you wanted to know about the second.
So have the markets priced in a successful coronavirus vaccine now that they're actually starting to put them out in the UK?
Yeah, so the markets have priced that in. So what's happened is we had some vaccine announcements. We had a big sort of boost in the market initially off a lot of those vaccine announcements, and then of course things get released where maybe some of the trials weren't as great, or the vaccine's effectiveness was only 80% or 90%, and so then the market sold off a little bit. So it is reacting to the vaccine news, but the reality is somebody, I think it's Pfizer, and then there's a couple of others, are rolling out vaccines. And I don't know about you, but I'm certainly not going to be the first one to rush out and get one, because there's still a 10 to 15% chance that people will have an adverse reaction to this thing, and I don't even know what that means, right? What does adverse reaction really mean? Am I going to die? Am I going to break out in hives? Am I going to grow a third arm? Am I going to turn into a zombie? I don't know what the adverse reaction is, but anyway, and look, for those who,
I don't know if that's the point, though, right? I mean, the point,
vaccine, but I'm going to wait to see what happens, right?
Yeah, the point is that I'm with you. I'm definitely not going to be first in line, and probably not in line at all. But the point is, it's this perception of stability and security in the market, and I'd really love to see if that's, because the UK is kind of a basket case. It's gone from the US to the UK as a basket case now. So to me, they look like they've gone, right, let's get this vax out next Tuesday, and come on, start lining up, and just so that they can sort of stabilize their markets. Is that what's actually happening?
Well, I think so. And, the COVID vaccine, if anything, it's going to have a positive effect, because people are going to just sort of breathe a sigh of relief that all of a sudden, oh, thank goodness we have this vaccine now, so we can take our masks off, we can, sort of relax all the restrictions and things of that nature. So it's definitely going to have a positive effect. It already has had a positive effect. It will probably continue to do so. Now that news will wear off, as we progress through vaccines being rolled out, and then obviously the feedback loop of any adverse reactions and things like that. So, it's just going to be a wait and see thing. But the key driver, that's just a narrative and a story. That's a subplot to the whole economic environment.
Right.
The reality is that we have the economies reopening. Today, I think Glasberejiklian here in New South Wales, we had another confirmed case of COVID pop up on the radar. But they're basically saying, look, we're investigating it, quickly. We're going to get right on top of this, but it's not going to change anything. So I think by Christmas, and we talked about this a couple of weeks ago, I said by Christmas, everything's going to be open again, because they have to get people back in the stores. They got to get people back out in the pubs and clubs and restaurants. They rolled out a program where every family was going to get like $100 of vouchers to go and patronize, patronize anywhere really, but for food and drink. So they're really trying to get the economy here fired back up, people out spending, which is a massive portion of our economy. About 60-70% of our economic activity is spending. So if people are at home and they're locked down, they can't spend. And if they're out and about and we have free movement and all the rest of it, then people can spend. And that's going to be a key driver of getting us fully recovered and the economy fully back firing again.
So I reckon there's a list we can probably do for our next show, like the trends of the year and the worst jobs. And my nomination for the worst job of 2020 isn't Dan Andrews' job. I reckon there's a job worse than that. It's these people in these local government areas that are tasked with testing people's sewage poo for COVID. I reckon that's got to be like the worst job of 2020, right? Testing people's excrement
Yeah,
for
I find that one
coronavirus.
really amazing. I sort of think to myself, COVID is in sewage. Okay, so what? What does that mean? Did it come from humans? Is there some sort of way that it is able to manifest itself there? I mean, it's one of those dumb things to actually even bother broadcasting because you just don't know how it got there and what caused it. I mean, for that matter,
Imagine being that bloke at the
it may
party.
have
I
been
mean,
there
the
forever, and
parties.
only because we've
Yeah,
tested for it now, we found it.
that's right. And what do you do if you're that guy or gal at a party? It's like, oh, what do you do? Oh, this is my job. Or you
Now,
go
whether
home
that
at
is-
night and kids say, hey, daddy, how was work? Oh, great, kids. Let me tell you about this test I did. I mean, come on. That's not
yeah,
that's not how you
it's
want to end the
probably you're
year.
right. It's probably got to be one of the worst jobs out there.
All right. Well, look, that's it. So let me paraphrase and tell me if I got it right. The markets are going very strong from early to mid next year. It's looking exceptionally strong in just about all Western countries of the world. We haven't talked about China. We don't have time to talk about that today. Christmas, the season economically is looking fairly sound from the data and the readings of the markets. And as it all stands, it's steady as she goes, and perhaps we're going to see a big run from first quarter next year. Have I got that right?
Yeah, pretty much. I mean, it's a green light. Everything's gone green, and so, and I don't mean green as in alternative energy green. I mean green light to be out there, confident about our economic prospects going forward, and the time to be cautious now, particularly with your investing, and particularly in stock markets, is you don't need to be. You need to be you need to know where to invest. The sectors of the market that benefit from quad two, that's what you need to know. I've mentioned a few of them today. And again, if you have your portfolio set up for those things, then mate, you will have a great first half of 2021.
Yeah. Well, there you have it. Thanks, PJ. Thanks for joining us, and I think we get to see you once more before the end of the year.
Yeah, looking forward to it. That'll be our last economic update or topic for the year, and then we'll have ourselves a little break.
Yeah, that's it. Well deserved one at that. All right, thanks for joining us today. And look, everyone, that was PJ Patterson from Keystone Financial. And he's been telling us all about the stock market status and what to look for in this Christmas crazy COVID season that we're seeing in 2020. And bring on 2021. Can't happen soon enough, I say. All right, that's enough from us today. I am your host, Scotty North, and we've been talking everything from money, finance, and property. And this has been Xenium Live.